venture performance has traditionally been measured in returns alone, but that definition is increasingly questioned. Heidi Lindvall, partner at Pale Blue Dot, argues that every company and every fund has impact, whether acknowledged or not. In this talk, she'll explore what great really should mean in European venture, and why responsibility, not just performance, must be part of how success is judged. Also vice versa, of course. Please welcome Heidi Lindvall from Pale Blue Dot.
If two funds both have top quartile performance, are they equally successful? For decades, we've been measuring success in VC almost exclusively by financial success. DPI, TVPI, IRR, with 2x fund being a good fund and a 3x fund being top quartile. But times have changed and industries have matured. And with that, with information being transparent, we do need a new way of looking at success. Let me be clear, performance will always matter. Without returns, the rest isn't possible. Now, but performance isn't excellence. Performance is the bare minimum to stay in the game. And if you're compromising a performance, then we're not playing the same game. Now, venture saves society. 75% of all of the value in the IPO market in the US have gone through venture-backed companies, or come from venture-backed companies. 92% on R&D spending. In the US, 12% of the private workforce work for VC-funded companies. And in Europe, that's slightly lower. It's at 5%, but it is still significant. So not only does venture shape societies, venture is actually part of deciding who gets funded at all. So that means that capital is not neutral. Every check that you write actually is a vote for what you want the future to look like. With that comes responsibility, and with that comes risk. Now, we've seen more than before venture funds getting scrutinized for what they invest in and whom. So more than ever before, venture funds are having to really think about their cultural and risk and what that actually looks like. Now, I want to propose a new way of actually looking at success, and I want to expand on this formula and what we before have been saying. Now, it starts with brand. Brand is no longer only your website or your logo. Brand is what people feel when they think about your brand. Brand is behavioral patterns that are tracked over time and become consistent. Then we have values. Values is what you do when things go wrong. So values is what you do behind the door, is how you act, the beliefs you have, and what actually guides you. Now, things always go wrong, and this is when we see what matters. In venture, we often say that you should only back your winners, but actually what you do behind closed door when things are not going well is also part of building who you actually are and what your future will look like. And then we have impact. Now, impact, you can look at two levels. You can look at the impact that your firm has on VC, and then you can look at the impact that your portfolio has on society. On a VC level, we often think about what is the actual impact that our firm can have. How do we shape society by how we act and what we say? We believe that climate is the biggest macroeconomic shift that we're going through. And if we can actually prove that to LPs, then we will have outsized returns. That also means that we can funnel more money back into climate, which actually will have a massive impact. And then on a portfolio level, impact is anything by who you invest in and what they do. How do they treat their employees? What do they do with the money when they're successful? And then, of course, what problem are they solving and how is that impacting society? So there's multiple ways of looking at impact. So I want to put these together and have a new scorecard where success equals performance times trust. And trust stands for brand, values, as well as impact. Trust compounds returns, and the returns compound trust. So it looks something like this, where low performance and low trust funds gone, out of the game. Low performance and high trust, I don't know if you can see this, irrelevant. Well-liked, value-driven, but they become irrelevant very fast. And then we have high performance and high trust, one-cycle wonders. You'll see these firms, they'll look good, but they won't last. And then we have high performance and high trust. And these are enduring firms that you'll see last for at least 3 cycles. So with performance and trust, I think we have a new way of actually looking at what venture success looks like, where it's not just what you do, but also how you've earned it. And that, to me, is meaningful. Thank you.
Narina, let's first get the introduction of you out of the way. You are, of course, representing Regeneration VC. We've had Regeneration here at the conference before. You are a fund dedicated to circularity. But maybe do your own introduction, and then we'll dive into it.
No, absolutely. Great to be here. So Narina Mnatsakanyan, I'm partner and chief impact officer at Regeneration VC. And before venture, I was more in institutional capital and pension funds and asset managers. So I can bring a bit of 2 worlds to this conversation.
So now let me ask both of you the real hard question. When times get tough, don't these good values fall out of the window and the brand and all this? All you really need is the money?
Money will always be there, as in those high-performing funds will always win. But when you start comparing high-performing funds, it's going to go to values. It's going to go to how you actually behave. It's going to go to what reputation lasts. So again, I think when you'll have those one-cycle wonders, you'll have those great funds that do well in bad times. But if they don't build up a brand and reputation where founders will choose them, I don't think it's going to last.
I think it's important, the past performance is important, but past performance does not guarantee a future performance. We all know that, but you tend to forget. And if you think about, what are we actually funding as VC? Now we're funding more linear and extractive business models that will cause overconsumption, and we're already, crossing 7 of the 9 planetary boundaries. Or do we actually want to fund the new type of world and technologies which are more regenerative and circular, and where we can actually live and survive as species within the humanitary boundaries in the long term? And that's where it also comes to, we were talking earlier this morning about getting more pension money into venture, and how do we do that? So if you think about from the pensioner and pension fund perspective, you do want to offer your beneficiaries good returns, but you also want to retire in a livable world. And I think that's important to think, what are we actually funding? And that's where the other factors like impact, values, trust, brand, your impact, and the portfolio you're funding come into play much more.
DPI is objective. Performance is objective. How much money do you actually produce? Brand, trust, values, these words are a bit harder. As an example, I think some would say that the brand value of Peter Thiel and Founders Fund is incredible, and also the performance. And there are others that, to them, Peter Thiel is a massive turnoff, and they would never touch that fund. Can you talk a bit about how you think about the lack of objectivity in this scale?
The thing is, you will obviously attract the type of founders that like your brand. You will attract the kind of people who are attracted to your values and who want to create that kind of world. And in the same way, even if we have great performance, us being a climate fund, I don't think we'll ever attract people who don't believe that climate change is real. Like, I don't think there's a certain political parties that I don't think ever will appeal to us, and that is just the way it is. But saying that, I do think that you have to have a certain type of behavior that appeals to people everywhere, whether you believe climate is real or not. People are going to expect to have investors that you can call, investors that will actually pick up your phone, that will actually care about their founders even when things are bad. And we've seen so many funds fall because of this. They just haven't gotten the basic rights. They've behaved badly at board meetings. They just didn't give a shit. They just wanted the money. And now a lot of those fund managers have had to leave because it's hurting the brand. So I do think that even if it's really hard to define what does good behavior look like, it's really hard to say what are the good values, etc. I do think that there's certain behavior, there's certain things like kindness and decency and integrity that we kind of expect from everyone. So, and I think we're going more of that way of actually defining that, what does that look like and what do we expect from our investors.
Marina, do you want to comment on?
Yeah, I think also on the question of like how do you measure other factors. I mean, if you look at the impact, you can absolutely measure and have different KPIs. I mean, we focus on circularity. I mean, if you look at emissions, for example, half is energy and climate, and the other half is also materials. You know, what are we actually, what kind of materials are we building from, and can we make that more sustainable? You know, how do we deal with waste? So you can absolutely look at, you know, what are some of the biggest problems in terms of emissions, linear resource waste, you know, toxicity. I mean, that's another area we haven't been talking that much, but it's super important. And looking at how can you have solutions which are actually replacing toxics that have more sustainable material, turn waste into new products, and keep materials in circulation. So that is something that you can also measure and track, and you can have your financial performance and you can have your impact performance. And I think the companies that would, you know, you would really hope that they do the best in the coming years are where you can have significant growth and financial success, both financially, but then also scaling impact, so addressing some of those big critical problems.
Heidi, you propose a framework here. Do you feel that LPs are sophisticated in this way? Do you see LPs today investing with a framework similar to that in mind? Or do you feel that there's still a long way to go?
I have been very positively surprised how people have, and a lot of LPs have really started asking more for brand and really started looking beyond performance. And like I said, performance will always matter. Like, we shouldn't discuss on whether we should compromise on that to have an impact. To me, that's not a conversation. Like, people do want to make money, and that's why they're in the game. But I have seen a trend on that. And as an example, we've actually turned a table. We do these things called value alignment assessments with our LPs. So we interview our LPs to try to figure out what their values are, what they think about diversity, how they invest, where they put the money that we return. So we actually have an idea of, if you're gonna give us money and then put it into oil, then it doesn't feel like we're doing a great job. So we're actually turning the table, and a lot of people are really appreciating that. They actually are starting to look at what they do in-house, and I feel like we need to change the game by start asking these questions. And I mean, so much crap has been done by the VC industry when we haven't been asking these questions. And now, like I said, when all this information is available, people being called out. So even whether you care or not, it kind of becomes a necessity to start thinking beyond performance.
Marina, any final remarks?
Yeah, no, we see that as well. I think with LPs, we have increasingly mission-aligned LPs who believe in our vision and the future. So I think that LPs play a huge role in determining how and where is capital allocated.